few years ago, I had the opportunity to visit my childhood elementary school. It was a bit tricky to find since it had been repurposed into a preschool. The key to finding it were my memories of sunshine streaming in the huge classroom windows on sunny days. Memories are a funny thing. They're often distorted by the passage of time and perspective. Now, although I am positive that the old school building did not shrink in size, it somehow seems smaller. So, in the grown-up world of investing, is the market more volatile than in the olden days, or is it our perspective? As visiting my old school illustrates, there's a difference between absolute and relative size. The building walls are the same height, but I'm not. The stock market is the same. If the Dow dropped 400 points in one day in January of 1970, that would have been a 50% decline. However, when the Dow dropped 586 points on August 24th of 2015, it was only a 3.5% drop. However, even when focusing on percentages instead of point drops, the bad news is that the market is indeed more volatile than in the past. Now, as I pored over the data, I identified what I call Dow Downer days, or drops of 3% or more. Now, in the post-war years from 1950 to 1970, there were only 9 days total in 30 years that the market dropped more than 3%. Contrast that to today. From January 2010 to August of 2015, there have been 11 such drops. Now, this doesn't even count the so-called dismal decade from 2000 to 2010 that saw both the dot-com crash and the financial crisis of 2008 and 2009, in which there were 43 Dow Downer days. So what happened? When will we return to the good old days? Now, I believe there are 4 major drivers of this increasing volatility. Number 1, instead of dancing around a maypole, on May Day of 1975, the SEC deregulated the brokerage industry, allowing for market forces to determine trading commissions. Now, instead of paying hundreds of dollars to buy or sell a block of stock, now investors pay about $10 per trade or less. Secondly, computerized trading has had a huge impact. High-frequency trading firms charge in and out of the markets in fractions of a second based on sophisticated computer algorithms. This led to the May 6th flash crash of 2010, in which the Dow dropped almost 1,000 points in minutes. Now, a third factor is the disappearance of employer pension plans. Instead of a pension and a gold watch, employees are given an 800 number and assigned a PIN. Experienced professional managers have been replaced with robo-advisors. Number 4, finally, I believe the media exacerbates these factors by yelling, "The sky is falling, the sky is falling," 24 hours per day, 7 days a week. Investors are more likely to engage in emotional investing. Regrettably, I don't think any of these factors are going away. The best protection is to ensure that you balance your need for growth, income, and safety in a way that allows you to sleep at night. Give us a call at 480-503-0050 if you need any help with this. Because in the words of Betty Davis,
fasten your seatbelts. It's going to be a bumpy night.
This has been a Loki production.